Good morning, ladies and gentlemen. Welcome to 2017. I wish we had more inspiration for you, but we are actually quite clueless at the moment about further developments. It is all much of a muchness. It is obvious from the charts of the 2 and 5 year notes that we are at the moment in a slight risk-off period in the States, while we're still in a full risk-on period in Europe. The 2 year note is retracing towards the break point, which is around the 108.16 area, while the 5 year note is also retracing. This is the weekly yield chart. It's also retracing towards the 187.50 area, which is the big break area that it broke out of about 3 weeks ago on a closing basis at the beginning of December. We think that that level will be retested, and after some play around the 187.50 area, we will again break higher. How long that consolidation lasts, we have no idea, because it is obvious that the US and the EU are wildly diverging in terms of market behavior, both in equities and in not so much in bonds, but certainly in equities. We would not be surprised by a move to, say, 178 or 175 in the 5 year notes, but we certainly think it pays to persist with short positions in FV, the 5 year note, because we think this area here between 216 and 235 will trade at some stage in the first quarter. The yield curve in the States is definitely flattening. This is a daily of the 10 year note, and again retests of 233, 237 in terms of yield should definitely not surprise. We are a very long way away from the 200-day moving average and even from the 50-day moving average, so moves back down here will be healthy and will not be a sign of anything but a intermediate term correction before the market attempts to go towards the 3% yield mark. Now this is all in the longer term very supportive of the dollar, and we see no reason to change our mind about that. The 30-year note has been quite anchored. It seems that inflation expectations are anchoring the 30-year note around this area, around the 3% mark, give or take 10 basis points. And we think that the 30-year note is actually going to remain stable around these levels, while the 5-year note and the 10-year note correct somewhat. And then finally we will have the big flattening of the yield curve when yields in 5s and 10s start approaching the 30s. We think the 30s are going to be anchored for quite a while around this area, while the 5 and 10 year notes, after they have corrected downwards, they then catch up to the 30-year note. It's all dependent, it's all squaring up of positions ahead of any announcements by the new Trump administration. If, as we expect, they are quite aggressive in their deficit increase program, then the 30-year note will be probably the least affected, and the 5s and 10s are going to scream higher in yield sometime towards the end of January, when the details of the program become evident. The Bund is actually best seen in terms of yields. As we expected, we are going to have a retest of this area, which is 7 basis points to 5 basis points. That probably equates to another 100 points higher than we are now. And let's have a look at that. That probably equates to around the 166.50 area in the March Bund, where we topped out many times before, and we have a succession of lows where the longs are still trapped. We think that over the course of the first couple of weeks of January, we might well test that 166 to 166.50 area, and we will be buyers of puts at those levels. We think those levels are unsustainable for the Bund, and we will be looking to put on good sized shorts at those levels. As far as the dollar is concerned, all we've had so far is movement in yields almost parallel in the US and in the EU. Both bond markets have been rallying slightly, and the interest rate differential between the two is actually nearly unmoved over the past 3 weeks. That is why the dollar, the DX, has been doing almost nothing, trading in a 1–1.5% range. We would expect that to continue to trade no lower than 101 to 100.5 before it makes its final move up towards 105 to 107. So the range for the month of January, we will say it's 150 all the way to 105, which would be the level that we expected to reach when people realize how aggressive the Trump administration is going to be in terms of deficit addition and deficit spending on infrastructure and tax cuts. That will be the next catalyst once they announce something and the market can actually ascertain how aggressive they're going to be. In terms of equities, we have a clear dichotomy between the US and Europe. The US topped out at the beginning of the month and has been retracing ever since. The movement so far has been very small. Well, we are not even 2% away from the highs. We would expect this churn to continue as people reduce positions which were very long indeed. As you can see from this indicator, we are now nearly back to neutral. Around 1 would be neutral, 1 to 110 would be neutral. Anything over 130 is way overbought, and people are being way too optimistic. The market, we expect, will test the 2200 level at some stage. We don't think that it's going to break it very easily. It is, we think, just a case of people reducing the size of their longs ahead of the Trump inauguration, feeling that most of the good news is in. That is probably not going to remain so. There is going to be another wave of buying at some stage, which should take it to new highs around the 2300 to the 2330 area. But as we have shown you many times, the ES has very little room to appreciate much further. We are cognizant of the argument that with tax cuts, these lines of these Blue Engine lines could be shifted upwards. Well, our argument to that is that most of the corporations in the S&P 500 don't pay any tax as it is. So how much is the reality going to shift the expectation? We are really not very sure. Can it shift it up to 2300? Yeah. Can it shift it up to 2330? Yes. But we think we are very close to an area of churn at best. Maybe something like this in early 2015, where the index just traded between 2-3% below and the top line. Well, we are at the top line, so 2 or 3% lower would be another, let's call it 50 points, and we closed at 2330, so that would be 2280 up to 2330, 40, 50 before the next wave of buying, which could take it a little bit higher, and then the retrace. We don't think the highs are in as yet. We think there will be further highs later on after the Trump package is announced, simply because this would be too easy. We definitely think there will be a trap of longs back up over 2300 before we have any sustained moves lower. So at the moment, ES is probably the least favorite of our stock market longs. If we look down at the breakdown of the sectors, the consumer discretionary is still not making new highs, and very little can be the index can be helped very little by this sector. The consumer staples are going rapidly nowhere. Energy is still a complete mess. The financials are about as high as you can get without a much steeper or higher yield curve, and we don't think they're going to get that anytime soon, certainly not before Trump announces any measures. The one sector in the United States that we like is the healthcare sector, because it's very reasonably priced and it is defensive. So it achieves two objectives. One is you're buying something with some value, and secondly, you have an upside call on a Trump surprise. So we quite like the healthcare sector at these levels. We think the downside is quite limited. You can set a very sensible stop below these lows, and it's one of our favored sectors once again. The industrials, well, we just can't see them much higher unless Trump springs a surprise on the tax cutting front, which we don't think he will. We think the market here has discounted 99% of all the good news. XLK has room to fall back because it is the most volatile sector, but it also has the most room to go up if you want to be aggressively long. So at some stage when the index falls down to the 2200, maybe 2180 area, XLK for a surprise is going to be a sector that we really like. Maybe something like long calls in XLK and long calls in XLV could be the ideal combination for the Trump inauguration period. While the ES languishes, the Europeans, as expected, are doing their own thing. This is a weekly chart of the DAX. It is vastly overbought. It is again through the Bollinger Bands, and it will come back at some stage. But this is something that doesn't look like it needs to be shorted yet. We would have thought that the 11,830 to 40 area would be the first area to attempt some shorts on that market. We still like it longer term, but we think that it is probably slightly ahead of itself. The stocks as we have shown you a few times, is coming into the target area, well, has actually gone through the target area of 3,287, and it's now approaching the 3,325 high. We think that would be a good area to probably short it with a 20 tick stop and see what happens. Just like the DAX, it is hugely overbought. On the other hand, it has far more potential than the DAX in the future. We would love to see it come back and retest these levels around the 3,175 to 3,200 area, where we think it would be very good risk reward to get long of it for another wave higher that could take it all the way up to 3,400 to 3,500, but that is in the medium term. Certainly we would expect that towards the end of the first quarter rather than in January itself. All of which gives us our biases for the trading week. 5-year notes, we don't care if we get stopped out, we will keep on trying again. The 118.08 area is the next favored area for shorts. Bunds, we hope they get to 3 or 6 basis points, and that should equate to the 165.50, 166 area in the contract, where we shall definitely short it. ES is still preferred contract for shorts. We see very little sustainable upside in ES. We see much more longer term sustainable upside in NQ. So if we ever want to be aggressively long, we'll be going long NQ and short of ES. Russell 2000, we still like it. We see very little downside in that contract unless Trump hugely disappoints, which we don't think he will, because it would be jolly silly of him. European equities, certainly much better longs than the US, than ES, but they are at very good resistance here at 33.25, where you can definitely try shorts with a 20 tick stop. Aggressive longs at this level are just a very poor risk reward. We would much rather wait for it to come back down to the 31,675, 3,200 area and then initiate some aggressive longs. In the US dollar, we still think volatility is the way to go. The relationship between the fixed income markets in Europe and in the United States is completely unsustainable, and we could have a cascade in the dollar, as we said, all the way to 105 to 106 in terms of DX, so that would be another 4% from here. We certainly think that that happens by the end of the month after the Trump inauguration and the unveiling of some tax plans. So those are our biases, and thank you very much indeed for watching, and wish you a very profitable 2017. Thank you.